Rick Santelli is standing by at the CME in Chicago. You got a little bit of time because I know you got some thoughts ahead of it, Rick, and then the numbers, of course.
Yeah, well, my thought is we're staircasing in interest rates. All Treasury yields yesterday traded higher than Friday's highest yields. Today, they're trading higher than yesterday's highest yields. That's called the staircasing when you're a technician. And it means that the markets are what I call guns hot. So you want to be very careful. Interest rates are on the move, and that move is higher. Retail sales hitting the wires for the month of September, expecting up 0.3 on headline, more than double, up 0.7%. To find a higher number than that, you have to go back to January when we were up 2.8, although we did have another 0.7 read in May. If we look at it in ex-autos, still very strong, up 0.6. Up 0.6, well, in comparison, if you look at July was up 0.7, so you can see that's where it comps. We've had back-to-back up 0.6. If you strip out autos and gas, it still remains very strong, up 0.6. And if you look at the control group, which goes into other numbers up the economic food chain, it is also up 0.6. 0.6 are wild. Now, revisions are coming in. If you look at headline, which was 0.7, last month 0.6 moves up to 0.8. Ex-autos, 0.6 last month moves up to 0.9. Ex-autos and gas goes last month from up 0.2 to up 0.3. And that control number I just gave you, which was up 0.6 in the current read, moves from up 0.1 last month to up 0.2. So we have much stronger numbers for September. August saw positive revisions across the board. Yields are moving higher. We're getting very close to challenging 4.80 in a 10-year. Currently at 4.78, it's up 7 basis points on the session. 2-year, which is moving but not nearly as fast, which means we're taking some of the inversion out of the yield curve, put more steepening back in, currently trading 5.14. That's up 4 basis points. So we want to continue to keep in mind that all maturities, as I said, are trading higher than yesterday's yields. And should we close above 4 3/4 today, you most likely will see more follow-through on a 10-year for the rest of the week. Andrew, back to you.
Thank you, Rick. Meantime, our friend Steve Leisman has also been monitoring these numbers, trying to make sense of it. Help us, Steve.
Shaking my head here, Andrew. This is a wow. I want to give you a little context here. It was the strong consumer spending numbers from June reported on July 18th. And if you look back at the 10-year going back to that, that was the beginning of this surge in bond yields, this reassessment of third quarter growth that all of a sudden we were going to pop here in a big way, and we did, and it has been maintained. For context here, the consumer didn't have to do anything in the month of September to still have that 3 or 4% growth rate. Now that that number is even higher, the way it worked, June came up and it was a good number. July just had to be steady, August steady. Instead, it keeps going up. They revised up the prior. This is the consumer that just won't quit for reasons people are just not capable of understanding. And it was not gasoline station sales, which we expected some strength there. Instead, it was just, what was it, just 0.6, I think I saw. It was 0.9 on gas stations. People expected more than that. But across the board here, I'm looking at relative strength. Motor vehicles and parts up 1%. That was expected. Even that may be a little bit light, guys. Retail sales, non-store retail, the internet sales were strong. So we don't have a consumer that's going to quit here. And I just have to wonder how much of a problem that is for the Federal Reserve. And while I do that, I'm going to look at what happened to the probabilities of rate hikes. They are a bit stronger for December. And by the way, the new development here is people are starting to take a small gamble that if the Fed doesn't hike in December, it may hike in January. Again, these numbers remain below 50%, but what I'm noticing now is the probability of a hike is now higher in January than it is in December, and it's almost nothing for November. So what's going to happen today, guys, is I suspect that these GDP tracking forecasts that we follow are going to be higher as a result. And we were already, near 3% on the average. The Atlanta Fed was near 5%. They may yet go up further towards, I don't know what number, 5.5% or 6%. And just one other question here, which is there should be a fall off in the fourth quarter. The question is how much of a slowdown there is.